In this lecture, we're going to discuss the accounting for one of the most common liabilities a company has, money it has borrowed from the bank. Bank loans are recorded as notes payable, and they can be considered a current or a long-term liability, depending on the length of time the money is borrowed for. While recording the issuance of the note is pretty straightforward, it's important that the cost of borrowing that money is recorded appropriately to ensure the usefulness of the income statement. This is a great place to start because the mechanics are uncomplicated, and they connect directly to concepts you have likely already learned. So let's get into it. Here's the situation. You borrow money from a bank today, the cash hits your account right away. That part's easy. But the cost of borrowing, the interest, doesn't get paid today. It builds up day by day, and you might not actually pay it until months from now, maybe even in a different accounting period. So the question is, when do we record the interest? If we wait until we actually pay it, we'd be ignoring a real cost that's accumulating right now. That's where accrual accounting comes back into the picture. We need to record the cost of borrowing during the period of time that we're using the money that we borrowed to make money, matching the expense to the revenue. If you think about it, interest is a lot like rent. You pay rent to use an apartment or an office, and it makes sense that you would recognize rent expense during the period of time that you use the space. Interest is like paying rent on a briefcase full of cash. We need to recognize that expense while we're using the contents of the briefcase to grow our business and increase our profits. Before we recognize anything, let's remind ourselves what a liability actually is. According to GAAP, a liability is a present obligation to transfer an economic benefit as a result of a past event. Let's unpack that. It has to be a present obligation, something that binds the company right now, at the balance sheet date. And it has to arise from a past event, the borrowing, the purchase, the service that already happened. Sometimes liabilities are obvious, like an accounts payable when you buy on credit. Sometimes they're less obvious, like a lawsuit, and we'll get to those trickier ones later. But for now, a bank loan is about as clear-cut as it gets. You borrowed the money, you owe it back, and you owe it back soon. That word soon matters. We classify a liability as current if we expect to settle it within 1 year of the balance sheet date, or within the operating cycle if that's longer. Otherwise, it's long-term. A short-term bank loan is a current liability. The formula to calculate interest is simple. Interest equals principal times rate times time. We use the word principal to describe the amount that was borrowed. This is also the amount that we have to pay back. The rate is the annual interest rate. Unless otherwise specified, you can always assume that the interest rate is an annual rate, so for 12 months. Finally, time is the fraction of a year that the loan has been outstanding. That last piece, time, is a critical component for accounting purposes. Interest accrues with the passage of time. It doesn't wait for a payment date. So if you borrow money in October and your accounting period ends December 31st, you've racked up about 3 months of interest by year end, even if you haven't paid a cent of it yet. That interest is a real expense of this period and a real obligation at year end, so we have to record it. Let's walk through the 3 accounting moments in the life of a bank loan that crosses a period end. First, when you issue the note, and notice that language, to issue a note, it means that we signed a piece of paper, a note, that says we will pay the money back that we borrowed with interest. When that happens, you debit cash for what you received and credit note payable for what you owe. Simple enough. Second, at year end, this is the adjusting entry. You accrue the interest that has built up so far. You debit interest expense and credit interest payable for the interest earned by the bank through December 31st. This is the entry that keeps the expense in the correct period. Without it, you'd understate your expenses and your liabilities at year end. Third, when the note matures, you repay everything. You debit note payable to clear the principal, you debit interest payable to clear the interest you already accrued, and you debit interest expense for any additional interest that built up in the new accounting period. And you credit cash for the total payment. Notice how the interest gets split across 2 periods. That's accrual accounting doing its job, making the financial statements actually useful. Now let's work through one of these together. Imagine on November 1st, a company has borrowed $700,000 from the bank and issued a 9-month, 12% promissory note, interest payable at maturity. Notice the word issued here. Also notice the word promissory, because that's exactly what happened here. We signed a note that says we promise to pay back the principal of $700,000. 12% is an annual interest rate, but also notice that we didn't borrow this note for 12 months. We only borrowed the money for 9 months. And even though we don't have to pay the interest until August 1st of next year, it's December 31st now. And that means we need to run our financial reports. That calls for an adjusting entry to record the cost of borrowing this money for November and December of this year. To wrap
Before we
up,
make the
a
journal
bank
entry
loan
on December
creates a note
31st,
payable,
let's go
which is
ahead
a
and
present
record the
obligation
note.
arising
So
from a
the
past
issuance of the
borrowing
note was
event.
11.
This also happens to be the definition of a
And
liability
what
straight
happened
from
when we
GAAP.
issued
Present
the
obligation,
note, which means we
past
borrowed money and we
transaction.
signed a piece of
We
paper.
learned that interest
that
accrues
says
with
we'll pay
time,
back.
regardless
We
of when
debit
cash
cash.
actually changes
And
hands.
notice I have
and that
the
we need to
accounting
record the
equation
interest
across
at the
the top
end of the
here
year
because
before we
I like
generate
to
our
keep
financial statement.
some T accounts to help us
Maturity is the day
visualize
that we
what's
have to
going
pay
on.
back
And
the
I recommend that you do the
principal, and
same.
sometimes
So we're debiting
also when the
cash
interest is
for
due.
$700,000.
Properly accounting
and
for
the
the
claim
cost
to
of
that new
borrowing
resource,
ensures that
right?
all
We
the
have a debit over
expenses
here
that
for
were incurred
$700.
to generate
It
revenue
belongs
this
to the
year
creditors,
are
not the
properly
owners of the company.
presented
So that
and
represents a
ensures that the
liability, a
income
note
statement
payable, and that's why we have an
continues to
account
be
over here
useful
under note
for
payable
assessing a company's
for
performance.
$700. And on December 31st, we now need to record the 2 months of interest for the months that have gone by. So we're going to record interest expense. We need to calculate what that interest expense is. And we have a 12% rate of interest. That is an annual rate. So if we multiply 700,000 by 12%, we're going to get $84,000. And that $84,000 represents 12 months worth of interest. Well, this is only a 9-month note, first of all, but also only 2 months have gone by. And here's the tricky part. We need to make sure that we're going to multiply this by 2 over 12 because this represents 12 months of interest. Even though our note is for 9 months, this calculation right here is for 12. So that will give us what our interest expense for the current year should be. And that would be $14,000. So this answer here is $14,000. And then we'll credit, because we don't have anything due right now until the end of the note, we'll credit interest payable for $14,000. So while we have over here under retained earnings, remember all of our expense accounts represent debits to retained earnings, and all of our revenue accounts are credits to retained earnings. We only keep the temporary revenue and expense accounts open during the year. So our interest expense account is temporary and it'll end up in retained earnings. It's going to have a debit of $14,000. And I know I didn't put zeros here, so let's be consistent. We're also going to have over here under liabilities an interest payable account with that $14,000. So we have a liability, a claim to our resources that doesn't belong to us, and it actually represents a reduction in our claim to resources because we're going to have to pay it. So that's what we do on December 31st. Now, when the loan gets repaid on June 1st, so 9 months later from November 1st, on June 1st, we're going to pay the note. Myself a little room, so 6-1. We first need to wipe out these liability accounts, right? The notes payable and the interest payable are no longer going to be there because we're going to debit those accounts. So we'll debit notes payable for the principal. We have to pay this back for $700,000. We also have to debit that interest payable account because we're actually going to be paying the interest for $14,000. So I'll put 700 here. Now this account is 0, and I'll put 14,000 here. Now this account is 0. But that's not all, because it's been another 7 months since we borrowed this money, which means we owe 7 more months of interest. And we had calculated that 14,000 was the amount for 2 months of interest, but we now need to know what another 7,000 months of interest is. So I can do this a number of ways. I can take that 84,000 and multiply it by 9 over 12 and subtract the 14, or I could just take the 84,000 and multiply it by 7 over 12. And either way, I get my answer of what is the remaining interest expense on this note, and that is going to be $49,000. And then in total, I credit cash. I'm paying back the $700, and I'm paying the full 9 months of interest. So an additional $700 or $63,000 on top of the $700,000 of principal. So I can add those to my T accounts over here, $49,000 of interest expense and total cash of $763.